The most dangerous economic shifts are not crashes. They are withdrawals. Because crashes are loud. Withdrawals are quiet. And by the time people realize demand is gone, it's already been gone for a long time. So how does demand vanish so suddenly? Why does it feel like buyers, consumers, and investors all disappear at once? And why does history show this same pattern repeating again and again? To understand that, we need to start with a simple truth most people misunderstand. Demand does not disappear because people want less. Demand disappears because people can no longer move. Every boom creates an illusion. Prices rise and everyone assumes demand is strong. Transactions increase and everyone assumes confidence is high. But those signals lie. Because real demand isn't desire. Real demand is capacity. The ability to commit. The ability to absorb risk. The ability to say yes without fear of being trapped. And capacity is fragile. It depends on credit conditions, on income stability, on future expectations. When any one of those weakens, demand doesn't slow gradually. It steps aside. History proves this. In the late 1920s, demand looked unstoppable. Consumer credit exploded. Stock prices soared. Real estate boomed. But beneath the optimism, household balance sheets were already stretched thin. When credit tightened just slightly, demand didn't fight. It vanished. The same thing happened decades later. In the early 1980s, inflation had eaten purchasing power alive. Then came the sharp interest rate shock under Paul Volcker at the Federal Reserve. Demand didn't collapse overnight. It froze. Consumers paused. Businesses delayed. Investors stepped back. Not because they didn't want to buy, but because the cost of being wrong had suddenly become too high. Demand only exists when confidence moves forward. The moment confidence stops moving, demand disappears, even if money still exists. This is why demand collapses feel sudden. They aren't created by panic. They are created by hesitation. One buyer hesitates. Another waits. Another decides to see what happens. And suddenly, listings sit. Inventory piles up. Prices stall. This is the moment everyone misreads. They say, it's seasonal. It's temporary. People are just waiting for better deals. But waiting is the disappearance. Because demand that waits is demand that no longer supports prices. And prices, once unsupported, begin to fall, not because sellers panic, but because gravity returns. There is a switch in every economy. Most people never look at it. It's not GDP. It's not employment. It's not inflation headlines. It's credit willingness, not credit availability. Willingness. Banks can be open. Rates can stabilize. Loans can technically exist. And yet demand can still vanish. Because people no longer want to borrow. This is exactly what happened after the 2008 crisis. The system was flooded with liquidity. Rates were slashed. Programs were launched. But demand did not immediately return. Why? Because once people experience financial trauma, their behavior changes. Debt stops feeling like opportunity. It starts feeling like a trap. That psychological shift lingers far longer than recessions. And when that shift spreads, demand doesn't rebound quickly. It stays missing. Demand is built on one assumption. Tomorrow will be stable enough. The moment that assumption cracks, demand retreats. People don't need to be certain things will get worse. They only need to be uncertain that things will improve. That's enough. This is why demand often disappears before job losses rise, before official recessions are declared, before markets crash, because expectations move first. When households sense instability, they conserve. When investors sense volatility, they pause. When businesses sense slowing momentum, they cut expansion. Each decision seems rational. Each decision feels temporary. Together, they erase demand. Here's the part rarely discussed. When demand disappears, power changes hands. During booms, sellers hold power. During demand withdrawals, buyers do, but only the strongest ones. Cash becomes leverage. Patience becomes dominance. Liquidity becomes authority. This pattern is ancient. Empires understood it. Industrialists exploited it. Central banks respond to it, often too late. Those who survive demand collapses are not the bold. They are the liquid. They don't chase. They wait. Because when demand is gone, time favors the prepared. Demand never disappears without signals. But the signals are subtle. Longer decision times. More negotiation. Fewer bidding wars. More thinking about it. These are not neutral signs. They are early symptoms. By the time sales volumes drop sharply, demand has already left the room. What remains is activity pretending to be demand. And that illusion can last just long enough to trap the unprepared. Demand doesn't disappear by accident. It is almost always engineered. Not deliberately, but structurally. And the most powerful forces behind it rarely look dangerous when they are introduced. They look responsible. They look stabilizing. They look necessary. Pause. This is where most people get it wrong. They assume demand vanishes because of fear, or headlines, or bad news. But historically, demand disappears because policy changes the cost of certainty. And certainty is what demand feeds on. Every slowdown produces the same instinct. Stimulate demand. Lower rates. Inject liquidity. Encourage borrowing. It sounds logical. And sometimes it works. But only when confidence is intact. Once confidence is damaged, stimulus behaves very differently. Instead of pulling demand forward, it exposes how fragile demand already was. History shows this clearly. After the dot-com collapse in the early 2000s, policymakers aggressively loosened financial conditions. Rates fell. Credit expanded. Risk was encouraged. Demand returned, but it returned distorted. It didn't flow into productivity. It flowed into leverage. Housing. Speculation. Debt-fueled consumption. Demand looked strong, but it wasn't rooted in income growth or stability. It was rooted in cheap confidence. And cheap confidence always evaporates quickly. Demand doesn't vanish when policy becomes restrictive. It vanishes when policy becomes unpredictable. This is the difference most people miss. In the late 1970s and early 1980s, aggressive tightening was obvious. Rates soared. Borrowing collapsed. People understood why demand slowed. But modern demand collapses are subtler. Rates rise, yes, but that's not the real trigger. The real trigger is when households can no longer model their future. When mortgage payments fluctuate wildly. When refinancing assumptions break. When monthly costs feel unstable, that's when demand retreats. Not dramatically, defensively. People stop asking, "Can I afford this today?" and start asking, "What happens if something changes?" That single question kills demand faster than any recession headline. One of the most dangerous phrases in economics is pent-up demand. It assumes desire accumulates harmlessly. It assumes waiting strengthens future demand. But history shows the opposite. Waiting reshapes behavior. The longer people wait, the more adaptable they become to not buying. They downgrade expectations. They delay life decisions. They adjust lifestyles. And eventually, the demand never comes back in the same form. After the global financial crisis, millions didn't just delay home ownership. They abandoned it. Not out of protest, out of recalibration. That recalibration permanently altered demand curves. Once people learn to live without something, demand does release. It expires. Here's a hard truth. Rate cuts don't revive demand when fear has replaced optimism. They only reduce pressure on those already committed. If someone is unsure about buying, cheaper borrowing doesn't help. Because the problem isn't price. It's commitment risk. Lower rates say, "You can afford this." But the buyer is asking, "Can I escape this if I'm wrong?" That's why demand often stays weak, even after policy pivots. People wait for confirmation, not incentives. And confirmation always arrives late. During expansions, demand behaves like a herd. One buyer validates another. Rising prices confirm decisions. Momentum feeds confidence. But when momentum breaks, demand becomes individual. Everyone reassesses alone. And herd demand never reforms quickly. Because trust, once broken, doesn't synchronize easily. This is why recoveries often feel uneven. Some segments rebound. Others stay frozen. The economy moves, but demand does not move evenly with it. Policy is reactive by design. It responds to data. But demand moves on expectations, not data. By the time demand shows weakness in the numbers, it has already psychologically withdrawn. This lag is fatal. It creates a gap where policy appears supportive, but demand remains absent. And into that gap, instability grows. Asset prices wobble. Liquidity concentrates. Volatility rises. Demand doesn't return during this phase. It waits for something stronger than policy. It waits for clarity. This is the turning point. When demand disappears, the economy doesn't stop. It reorders. Sellers lose leverage. Buyers gain options, but only if they have patience. Speculators exit first. End users hesitate. Institutions slow down. And those with liquidity begin to dictate terms silently. No announcements. No declarations. Just better positioning. This is how power shifts without headlines. Ask this not as theory, but as reality. If demand were truly waiting, why hasn't it rushed back when conditions improved? Why does hesitation persist even after incentives return? Because demand isn't asleep. It's retrained. And retrained demand does not respond to old signals. No one announces it, but everyone notices. This is how caution spreads faster than optimism. Because optimism requires belief. Caution only requires observation. When people see others waiting, they infer information. Maybe they know something I don't. And so they wait too. Not out of fear, out of self-preservation. This is how demand disappears without a single shocking event. At the peak of every cycle, risk feels invisible. Leverage looks smart. Debt looks efficient. Commitment feels rewarded. Then something changes. Not prices, not policy, narrative. Conversations change tone. Instead of, "This will pay off," people start saying, "What if this goes wrong?" That sentence alone changes everything. Opportunity becomes exposure. And demand cannot survive when exposure dominates thinking. One of the biggest myths is that demand needs bad news to fall. It doesn't. It only needs uncertain silence. When news becomes mixed, when signals conflict, when experts disagree, that ambiguity is deadly for demand. Because buying requires conviction, and conviction cannot exist in fog. So people do nothing. They don't sell aggressively. They don't buy confidently. They pause. And pauses, when multiplied, erase demand. There is a hidden equation every buyer runs. It's not about returns. It's about regret. How bad will I feel if I'm wrong? During expansions, regret feels minimal. Everyone else is winning. Mistakes feel shared. But when momentum breaks, regret becomes personal. Being wrong feels isolating. And people would rather miss an opportunity than be alone with a mistake. This is why demand doesn't rush back at lower prices. Lower prices don't reduce regret risk. They increase suspicion. This is critical. The waiting phase is not neutral. Waiting changes preferences. People delay life choices. They redefine needs. They accept substitutes. Rent instead of buy. Repair instead of upgrade. Save instead of spend. Each adjustment weakens future demand. By the time conditions improve, the original demand no longer exists in its old form. It has been replaced. This is why recoveries often feel disappointing. The economy recovers, but demand does not fully return. Money can be created quickly. Confidence cannot. Liquidity injections move numbers. Confidence moves behavior. And behavior lags. People need repeated proof that stability has returned. Not one good quarter. Not one rate cut. Not one rally. They need time without punishment. Until then, demand stays defensive. Here's a detail most analyzers miss. People don't look at charts. They look at other people. They ask, are others buying? Are others committing? Are others relaxed? When those answers are not really, demand stays muted. Even if fundamentals improve. Because demand is social before it is rational. Demand doesn't just disappear. It narrows. Only the safest buyers remain. Only the strongest balance sheets act. Only the most patient capital moves. Everyone else watches. This creates an illusion of activity. But it's not broad demand. It's concentrated demand. And concentrated demand cannot support system-wide prices. This is the part of the cycle that confuses everyone. Because people expect relief to look like recovery. But real recovery looks like hesitation with structure. Demand doesn't need optimism to return. It needs safety. Not safety from loss, but safety from surprise. People don't need prices to rise. They need prices to stop behaving unpredictably. They don't need policy support. They need policy consistency. Once punishment ends, once doing nothing stops feeling smarter than doing something, demand begins to move again. Not boldly, carefully. When demand returns, it does not start with confidence. It starts with calculation. The first buyers are not emotional. They are not hopeful. They are not loud. They are disciplined. They buy because downside has become limited, not because upside looks exciting. This is why early recoveries feel weak. Because they are not powered by enthusiasm. They are powered by acceptance. Here's a reality most people resist. Demand almost never returns to its previous size. Because the system has changed. Balance sheets are altered. Risk tolerance is reduced. Expectations are lowered. The old demand was built under different assumptions. Those assumptions no longer exist. So demand returns reshaped. More cautious. More selective. More conditional. This is not failure. It is adaptation. Every cycle promises a return to normal. But cycles do not rewind. They reset. New buyers replace old ones. New standards replace old shortcuts. New definitions of affordable and worth it emerge. What looks like weak demand is often just demand refusing old prices. This is how markets heal. By rejecting what no longer makes sense. There is one force more powerful than policy. Time. Time allows memories to fade. Allows balance sheets to repair. Allows trust to rebuild. No shortcut replaces this. Attempts to force demand back early often delay its real return. Because forced demand collapses again at the first shock. Natural demand stabilizes. This is the signal demand watchers miss. Demand returns when waiting becomes costly. Not emotionally costly. Practically costly. When rents stabilize. Alternatives narrow. Opportunity cost rises. Then hesitation loses its advantage. That's when movement resumes. Quietly. When demand finally returns, power has changed hands. Sellers no longer dictate. Buyers no longer chase. The system becomes negotiated. This is healthier than booms, but less exciting. And that's exactly why it lasts longer. Demand did not disappear suddenly. It withdrew intelligently. It watched. It learned. It adapted. And when it returns, it will not reward the impatient. It will reward the prepared. Long pause. Because demand is not emotion. Demand is trust. Expressed in action.